Hello, everyone. This is Rich Vessel, founder of Advanced Projections, with our April 2023 Advanced Projections Economic Report. We'll start with economic data highlights for March and the first part of April this year. Employment figures for March came in with another solid new jobs figure up 236,000, and unemployment moved back down slightly to 3.5%. We still expect that unemployment should eventually begin to gradually move upwards because at these low levels, the Fed must stay fully focused on inflation, given this fresh ammunition for further rate increases. Employment is a lagging indicator in the business cycle, so it typically declines after a downturn has begun. Annual CPI inflation through March was announced on April 12th, with consensus expectations for it to be around 5.1%, and the actual reported value was 5.0%. However, sticky price inflation, less food and energy, continued high in March at 6.5%, 1.5% higher than the more general CPI number. The producer price index fell 0.7%, a small moderating influence. The Federal Reserve added another 25 basis point rate increase to their Fed funds rate on March 22nd. We had expected them to implement a 50-point increase, and new inflation and employment numbers may make them go there again in the beginning of May. In mid-December, they issued new projections for 2023 through 2025, and they were looking for a longer fight against inflation with higher rates than they projected previously in 2022. The hot employment picture seems to confirm that scenario. They issued new projections in March, and the dot plot was proclaimed to be effectively unchanged, but close examination shows the most hawkish open market committee members to have increased their hawkishness, and that translates into continuing expectations for higher rates. Equities markets have gained as much as 10% since the October lows were put in, but recently have hovered around key resistance levels. The S&P 500 has tested overhead resistance around 4,100, where it briefly crossed above its 200-day moving average. The bond markets revealed that smart money is paying more attention to the Fed's signals and pronouncements, which were reflected in the S&P 500 dropping around 100 points during March. But it recovered when the banking issues were handled expeditiously and the Fed only raised rates by the generally anticipated 25 basis points. In early February of 2022, advanced projections gave an extreme risk warning for equities as the Fed was preparing to begin their quantitative tightening program that March. Here in April of 2023, there is continuing evidence of significant moves to cash, as reflected in the long-term bond market, as people are realizing the resolve of the Fed in their long-game battle against the inflation dragon. The recent bond trends reflect many more Treasury instrument purchases at the long end of the yield curve, which has accelerated the 3-month 10-year yield spread. This is a clear indication of a significant flight to safety as long-term investors seek to capture high long-term bond rates. Now, here are the current underlying economic details. Year-over-year consumer price index increases, and tight labor markets continue to affect many aspects of the economy. General expectations out just ahead of this March's CPI announcement were for 5.1%, and it came in just below that at 5.0%. The Federal Reserve will not be swayed much by that number, as the underlying sticky inflation numbers are not coming down as rapidly. Employment has not yet turned to a negative trend, and consumers are still spending record amounts on credit. Look for an upwards contribution to the CPI from increasing gasoline prices in April and May. The Bureau of Labor Statistics employment and the Federal Reserve's intentions are reflected as unemployment continues to remain well below 4% over the past 11 months, now at 3.5%, with new job gains in March of 236,000. We expect those gains to dwindle in the first few months of this year. We had expected that, but there's still no evidence of those numbers turning around yet. We now expect to see a more significant trend of layoffs begin late spring or early summer of this year. Below is the typical Table A showing the employment situation as reported by the Bureau of Labor Statistics. All employment numbers are up, including labor force participation rate and total numbers of employed persons. The currently solid employment situation continues to keep the Fed free to be as aggressive as they deem necessary in their rate increase script, as well as in their plans for unwinding their balance sheet, thus decreasing the money supply. They have already stated so right along with their 9 rate increases in the March 22 through March 23 timeframe and within their last available FOMC meeting minutes. Look for continued small increases when the Fed FOMC returns with its next steps at the beginning of May. Their February and March rate increases came in 25 basis points below our expectations, but based upon the coincidentally issued report, we do not expect any delicacy or wavering on their part in the beginning of 2023. Expect at least a 25-point bump later in May, perhaps as much as 50 points if they lend more weight to the still climbing credit debt, employment, and sticky inflation values. Now, we've also shown a table issued in the Fed's December 22nd report and updated it to the March report to show somewhat higher interest rates and longer-lasting inflation than they previously thought. This has been the case every quarter since their fourth quarter 2021 report. Higher rates for longer means more brakes on the economy, and they indicate they expect a full percentage point higher unemployment from the current 3.5% as a long-term consequence for 2023 through 2025. Very tepid GDP growth is anticipated as well. And we have some more to say about that later on in this report, where the GDP growth in this table is not reflected in their rhetoric or the Conference Board's rhetoric about expectations for a recession this year. In energy, the June through November 0.75% interest rate increases last year had already had an effect on the price of oil, driving it down more than 40% from $123 a barrel to around $75 a barrel. This was in spite of OPEC and Russia cooperating in an agreement, both financially and politically motivated, to restore their 2 million barrel a day production cuts, which were in effect in the first quarter of 2022. At the beginning of this April, OPEC and Russia agreed to an additional 1.2 million barrel a day production cuts to support prices for their oil. The markets responded by moving oil up over $80 a barrel again. We'll keep an eye on global demand forecasts to see where oil may go over the next several months, but our expected range for the next several months is $75 to $85 a barrel right now. Gasoline prices may yet push north of $4 a gallon during this spring, as a higher than usual number of refineries will enter maintenance shutdown periods, and this new jump in crude prices should add to the likelihood of higher gasoline prices across the country in April and May. We already are experiencing local increases over the past 4 weeks, so it shouldn't be a surprise if gas prices move near $4 sometime in late May. Natural gas prices may end their pricing breather that resulted from a fire at the Freeport, Texas LNG export facility. That facility has now fully returned to service, but a warmer than predicted heating season has depressed demand somewhat. U.S. natural gas consumption fell to lows last seen in February of 2018, 5 years ago, due to a warmer than expected winter. Now that the Freeport facility has returned to full LNG production, export activity should be back to near maximum. This one facility compresses 2.1 billion cubic feet of gas per day, and all of our combined LNG export activity compresses 13.9 billion cubic feet per day, which significantly represents 14% of our total domestic demand. We have a couple of tables in the report showing natural gas spot prices at the Henry Hub, and they're back down to quite tolerable levels now in the range of $2 to $2.50 a thousand cubic feet. And also natural gas consumption table as well. Now, there's a lot of yin and yang in the market forces that determine natural gas prices, but for now they have generally declined significantly from levels at the end of last summer. That may also relieve electric power production costs, as natural gas accounts for about 40% of the U.S. generation mix. The Energy Information Agency has issued their own projections for declining gas and electricity prices in the near future, but we are going to take a wait-and-see attitude before declaring high energy prices to be completely behind us. Note, for those of you who can select your natural gas supplier from a company other than your gas delivery utility, this would be a good time to begin looking for supply at a lower fixed rate, free of any cancellation or additional monthly charges. In the equities markets, fresh news in the form of that 236,000 new jobs and a modest Fed rate bump brought a little life back into equities. The first of what we expect to be several bank failures and identified weaker bank situations, such as Republic Bank, had originally added to market weaknesses. Quick confidence-boosting actions rescued the situation, and those seem to have prevented an emotionally driven bank panic. These events are likely to not temper the Fed's actions to quell inflation, however. We continue to expect significant interest rate increases and then further general declines in equities and bonds in the intermediate term. A return from the current index level just below bubble territory to warm market levels would take the S&P down to about 3650, and a correction to the mean would be near 3,000. However, if the S&P 500 pushes above 4250 in the next month or two, it would be returning to exceptionally high risk territory. In a typical bear market, negative investor emotions carry enough downward momentum to drive indices significantly below the mean, towards and through the inevitable retail investor emotions of despair and capitulation when finally the selling ends. There is no current reason to expect anything different this time, as the Fed still appears to be highly resolute in their attack on inflation, and that means more significant rate hikes should still be expected, beginning with the next one about 3 weeks after the release of this report. They've clearly stated what their targets are, that inflation has not begun to respond as significantly as needed, and they are dead set against pausing or quitting their program too early so as to avoid mistakes made in the 1970s during the last great battle with inflation. We have a longer-term chart with actual analyst projected values for S&P 500 earnings and revenue growth from 2017 through 2023. Our markup shows where we think they have miscalculated, similarly to what we did for the middle of 2022. The first test for the analysts will be when final fourth quarter 2022 earnings. If they continue to miss expectations en masse, it becomes more certain that 2023 will be weaker than currently expected. However, analysts like to understate negative expectations, but even so, they are reducing earnings expectations for the first quarter and second quarter of 2023, with a current projected year-over-year decline of nearly 7% for the first quarter of this year. Also, analysts' second quarter levels of buy recommendations are well below average, and sell recommendations are well above average. The majority of reporting companies are providing negative second quarter guidance. Now here's what FactSet says about calendar year 2023. Note how our recent monthly comments embedded in the chart, as shown in our written report, how that has played out in FactSet's current projections with 60% cuts to both earnings and revenue growth estimates. Look for further cuts ahead as the first half of 2023 unfolds in real time. Here's what FactSet says. Looking ahead, forward estimates and valuation earnings. S&P 500 expected to report earnings growth of 1% for the calendar year 2023. For the first quarter, S&P 500 companies are expected to report a year-over-year earnings decline of minus 6.8% and revenue growth of 1.8%. For the second quarter, analysts are projecting an earnings decline of minus 4.6% and a revenue decline of 0.1%. For quarter three, analysts are projecting earnings growth of 2.1% and revenue growth of 1.4%. For quarter four, analysts are projecting earnings growth of 9% and revenue growth of 3.7%. Well, we'll find out as they're pushing these things out. For calendar year 2023, analysts are projecting earnings growth of 1.2% and revenue growth of 2.1%. Those last three items reflecting later on in the year are going to be blown out of the water because, as both the Fed and the Conference Board state, we're going to be in a recession from starting around the middle of this year and proceeding onwards after that. A little bit more in the report later on that. There's a chart showing bottom-up earnings per share estimates for the S&P 500 for both calendar years 2023 and 2024. And you can see how they have been declining basically throughout this past year, in that analysts keep overstating, keep expecting more out of corporate revenues and earnings than has been realized. As of April 17th, FactSet also states the following. As of today, the S&P 500 is reporting a year-over-year decline in earnings of minus 6.5% for the first quarter, which would mark the largest earnings decline reported by the index since quarter two of 2020, where it was down 31.6%. And the second straight quarter, the index has reported a decline in earnings. Now here at Advanced Projections, we expect the entire year of 2023 to be down every quarter. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets and for breakdowns in this metric which appear ahead of real economic downturns. The February number for this metric was down again by 2.6%. As indicated in our markup on the chart, risk capital has clearly made some serious exits from the markets. An equity market bottom may be near on a historic basis when margin borrowing declines a full 55% from its previous high. So there is still potential for a further decline of around $750 billion to reach that point. Our markups showed the margin borrowing declines that appeared ahead of the last two recessions and associated market collapses. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.